Right now, at this exact second, there are roughly 80 massive commercial shipping vessels sitting completely motionless in the Strait of Hormuz.
Which is, frankly, a terrifying visual.
Yeah, I mean, we're talking about colossal steel structures,
Yeah.
each carrying hundreds of millions of dollars of raw energy just anchored in the water. It's not a shipping lane anymore. It's a parking lot.
Exactly, a highly volatile parking lot.
Right. And because of that parking lot, the global economy is sitting roughly 14 days away from running out of the very fuel that keeps it functioning.
It is the ultimate physical constraint. I mean, you're looking at a geopolitical choke point where a localized military standoff is literally physically severing the arteries of legacy energy distribution.
But the irony, and this is really what we're going to unpack today, is that on the exact same day, halfway across the globe, we're witnessing a completely different kind of extreme.
The tech boom.
Right.
Yeah.
The U.S. tech sector is currently in the middle of the most explosive, unprecedented wealth and technology creation event in human history through AI.
It's just staggering.
It is. They're trying to build the most energy-hungry machines ever conceived by human engineers at the exact moment the world's physical energy supply is held hostage.
So you have a world defined by a sudden, violent scarcity of physical commodities, right? And it's smashing headfirst into a world trying to scale infinite digital abundance.
That's a great way to put it.
And understanding how those two realities collide, I mean, that's really the only way to read the current economic landscape.
Which brings us to the mission of our deep dive today. We're going to connect the mechanics of this global energy crisis with AI's massive physical infrastructure demands. And then we'll look at how domestic tax policies are basically throwing gasoline on the fire by causing billionaire capital flight.
It's all incredibly interconnected.
It really is. But before we dive into the deep end of the data, I want to share a quick focus update for you listening. To access more advanced researches, applications, and our latest published personal intelligent, multi-agent deep value intelligence, welcome to subscribe on deepvalues.ai. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store.
And we also need to establish the baseline parameters for today's discussion. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel at Deep Values. Don't forget to like this video. Much appreciated.
Perfect. Thanks for that. So one final piece of context for you as we get into this. Our sources today pull heavily from a wide spectrum of, policy institutes, financial analysts, and geopolitical think tanks.
A really broad mix.
Yeah, exactly. You're going to hear us discuss the strategies of figures like Donald Trump, Joe Biden, various progressive lawmakers, and neoconservative strategists.
Which can sound pretty charged.
Right, but I want to be crystal clear here. We're looking at the raw telemetry data of global events, regardless of which political faction published it. We aren't here to endorse a political doctrine or take a side.
Absolutely not.
Our job is strictly to map out the chessboard and show you the exact mechanics driving the decisions of these global players.
And the most urgent dynamic on that chessboard right now is the mechanical reality of oil extraction in the Middle East. Our sources rely on a detailed breakdown by Halima Croft.
Oh, she's the former CIA analyst, right?
Yes, exactly. She currently runs global commodity strategy, and she outlines a scenario that the market is really struggling to price in correctly.
I mean, we've seen Brent crude oil violently whip around. It spiked to $84 a barrel, shot up to 119 as tensions flared, then plummeted back down to 90.
Right. And that drop to 90 was simply because of a televised presidential interview that suggested a diplomatic off-ramp.
Which is wild. And then it rocketed right back up to 100 the moment commercial ships reported taking fire.
That level of volatility implies sheer panic. And the timeline the sources keep citing is this 2-week window.
A 2-week window. Okay.
Yeah, they argue that if this standoff lasts longer than 14 days, we cross a threshold from a temporary price spike into structural, lasting economic damage.
Okay, let's unpack this, because you look at the 1970s oil shocks or even the geopolitical crises of the 1990s, and the world economy didn't vaporize in 2 weeks.
True.
So why is a 14-day pause in shipping the absolute point of no return today? Haven't we navigated this before?
Well, the answer lies in the subterranean physics of oil production. People tend to think of global oil supply like a giant light switch.
Like you just flip it off if the ships can't move.
Right. You just turn off the pumps, wait for the diplomats to figure it out, and then flip the switch back on. But petroleum engineering doesn't work that way. Because those tankers are anchored in the strait, Roughly 6.7 million barrels of oil a day are currently being forcibly shut in across the Middle East.
Shutting in, meaning they're capping the active wells because the oil literally has nowhere to go?
Exactly. Take Iraq, for instance. I mean, they have a production capacity of about 4.3 million barrels a day, but they never built massive domestic storage facilities.
Wait, really? No storage?
Very little. They rely entirely on a constant, unbroken conveyor belt of very large crude carriers arriving at their ports. So when the carriers stop arriving, the onshore storage tanks fill up in a matter of days.
They hit what the industry calls tank tops.
Yes. Hitting tank tops is the critical failure point because once the physical steel tanks on land are full to the brim, the pressure inevitably backs up.
Let me use an analogy here. It's like a bathtub, right?
Mm.
If the drain, in this case, the Strait of Hormuz, is plugged, you can only keep the faucet running until the tub is full.
That's a great way to visualize it.
And once it's full, you have to shut off the water, meaning shut in the oil fields. But turning that massive industrial faucet back on is the real problem.
Because it's not water, it's pressurized crude. When that pressure backs up through the pipeline infrastructure all the way down to the bedrock, permanent damage occurs.
Oh, wow.
Yeah. If you choke an active well and forcibly stop the flow of millions of barrels of pressurized liquid, you drastically alter the dynamic of the subterranean reservoir. You invite water encroachment into the oil-bearing rock formations.
And I read that the microscopic pores in the rock can actually collapse under the shifting pressure gradients.
Precisely. So to restart a severely choked well, you aren't just turning a valve.
It's a whole ordeal.
Oh, absolutely. You might have to bring in highly specialized rigs to drill sidetracks or inject massive amounts of chemicals to stimulate the rock, or even pump pressurized gas to artificially lift the dead fluid.
That sounds incredibly expensive.
It takes months of engineering and hundreds of millions of dollars in capital expenditure just to return to the baseline production you had before the shut-in.
Just to get back to normal.
Right. Iraq has already had to shut in 3 million barrels a day. Every single day past that 2-week mark drastically increases the probability of irreversible reservoir damage across the entire region.
You're painting a terrifying mechanical picture here. But I'm still looking at the historical precedents. The United States has navigated Middle Eastern instability for half a century.
We have.
I mean, we specifically built strategic buffers to ensure a localized conflict doesn't instantly crash the domestic economy. Why should the listener panic now?
Well, we did build those buffers, but the reality highlighted in the source material is that those shock absorbers are gone.
You're talking about the Strategic Petroleum Reserve, the SPR.
Exactly. It was mandated by Congress in the 1970s precisely to prevent foreign actors from holding the U.S. economy hostage. It's essentially a series of massive hollowed-out salt caverns along the Gulf Coast designed to hold over 700 million barrels of crude.
Right, the ultimate rainy day fund for the American industrial machine.
But we already spent the rainy day fund.
Oh, man.
During the initial economic shocks of the Russia-Ukraine conflict, the administration authorized a massive drawdown to artificially suppress domestic gas prices. We pumped roughly 180 million barrels out of those salt caverns.
And crucially, we never refilled them when prices temporarily stabilized.
Exactly. We're sitting at roughly 400 million barrels today.
Which sounds like a lot, but if we're losing access to 20 million barrels of crude products passing through the Strait of Hormuz every single day, releasing a few million barrels from a depleted SPR is like bringing a garden hose to a forest fire.
It might buy us a few days of psychological comfort, but it does not change the underlying math.
And the math gets exponentially darker when you look beyond just the energy sector, right?
Mm-hmm.
The sources highlight a secondary vulnerability.
Yes, a vulnerability in the Gulf region that dwarfs the economic impact of $150 oil. Desalination plants.
Because the Arabian Peninsula is essentially a massive desert.
Right. The Gulf states rely entirely on reverse osmosis desalination to keep their populations alive.
Which, by the way, is an incredibly energy-intensive process. You're using massive industrial power plants to force seawater through microscopic membranes at insanely high pressures to strip the salt out.
It requires uninterrupted baseload power and a highly vulnerable coastal infrastructure. Roughly 100 million people in that region depend on those plants for their daily drinking water.
100 million people.
Yeah. The sources note that 70% of the municipal water supply for Riyadh, a city of over 7 million people, comes directly from coastal desalination.
Wow.
And these facilities are incredibly soft targets. I mean, we've already seen the deployment of cheap asymmetric drone warfare in the region.
So if the conflict escalates and those power plants or the desalination membranes are systematically targeted, we aren't talking about a global recession.
No, we are talking about a countdown clock for human survival.
Right, because a modern metropolis in the desert has, what, maybe 48 to 72 hours of municipal water reserves?
Exactly. If the plants go offline, you are looking at making an entire geographic region physically uninhabitable in a matter of days.
That is the ultimate catastrophic risk driving the timeline in Washington right now. And the physical bottleneck of oil immediately forces a political and military reaction.
It does.
I mean, if the physical limit is 2 weeks before catastrophic economic damage, who is going to blink first on the geopolitical chessboard? The sources detail this intense, deeply fractured debate within the U.S. foreign policy establishment.
They're desperately trying to force an off-ramp before the structural damage becomes permanent.
So the intelligence outlines two entirely opposing frameworks. On one side, you have a highly surgical, pragmatic approach referred to in the documents as the Trump doctrine.
And the stated objective here is strictly punitive and limited.
Right. You authorize airstrikes to degrade the adversary's immediate military projection capabilities. You sink the fast attack boats, crater the runways, destroy the coastal radar installations.
And then, crucially, you declare victory and immediately withdraw.
Yeah, you don't linger. You don't attempt to rewrite the local constitution or install a friendly puppet government. It explicitly rejects the concept of nation building.
It's simply about resetting the deterrence baseline so the commercial ships can start moving again.
But that approach faces massive institutional resistance from the alternative framework, the neocon doctrine.
Heavily championed by entrenched defense think tanks and, visibly advocated for by editorial boards like the Wall Street Journal.
And their argument is that surgical strikes only delay the inevitable.
Right. They advocate for utilizing the crisis to enforce total regime change. They're suggesting the deployment of ground forces and the systematic dismantling of the adversary's nuclear and political infrastructure.
Which is essentially committing to a multi-trillion-dollar, decades-long occupation.
It's a massive escalation.
And what's alarming is how the financial markets are pricing these two options. The sources point to data from prediction markets, specifically Polymarket.
Where individuals wager actual capital on geopolitical outcomes.
Exactly. Right now, those markets are assigning a 57% probability that U.S. forces will be actively engaged on the ground in Iran by the end of the year.
So the individuals putting their own money on the line believe that catastrophic escalation is the most statistically probable outcome.
But this binary debate in Washington completely ignores the most powerful, silent variable in this entire equation.
If we connect this to the bigger picture, you have to look at China.
China is effectively the hidden main character of this crisis, because the United States is functionally energy independent in a crisis scenario. We produce roughly 13 million barrels of crude a day, right?
And we consume about 20 million barrels of total petroleum products. We'd face a severe recession, sure, but the lights would stay on.
China, however, is walking a tightrope without a net.
Their vulnerability is absolute. China imports massive quantities of crude. They're overwhelmingly dependent on the Middle East for the feedstock required to run their heavy industry.
Not to mention the transport fuel needed to maintain their domestic supply chains.
Exactly. And their domestic economy is already showing massive structural fractures. The sources cite an incredibly concerning statistic, a 25% youth unemployment rate in China.
25%. That's a quarter of their young workforce.
Millions of young educated citizens sitting idle. From the perspective of the Chinese Communist Party, that is an existential threat.
Because the unwritten social contract in China has always been that the population surrenders political liberty in exchange for guaranteed rapid economic growth.
Right. If the Strait of Hormuz remains a parking lot for 5 or 6 months, the Chinese manufacturing sector is starved of energy, factories shutter, supply chains freeze.
You would see tens of millions of people abruptly thrown into poverty.
And the resulting domestic instability is the CCP's ultimate nightmare scenario.
So what does this all mean for the upcoming historic summit between Trump and Xi Jinping mentioned in the sources? If China is hurting this badly, do they hold the key to the off-ramp?
Well, this brings up a fascinating concept from the sources, the grand bargain theory. We've been wondering why China has been so quiet diplomatically.
Right. They haven't mobilized their navy to aggressively defend Iran, nor have they canceled their scheduled economic summits with the United States.
Because their silence is highly calculated. They desperately need this conflict to end, but they want the United States to absorb the geopolitical cost of ending it. The theory posits that if the U.S. adopts the pragmatic, limited strike doctrine, degrading the immediate military threat and then immediately stepping back, The U.S. doesn't actually need to commit a carrier strike group to police the Strait of Hormuz indefinitely.
Because China will be forced to do it for us.
Exactly. If the U.S. withdraws, the burden of ensuring those oil tankers can move falls squarely on the nations that will literally collapse without them.
China, India, the neighboring Gulf states.
They will aggressively leverage their immense economic and diplomatic weight to force Iran to keep the shipping lanes open. They become the de facto security enforcers of the region out of pure, unadulterated self-preservation.
It is a phenomenal geopolitical paradox. We're watching nuclear-armed superpowers engage in a massive game of chicken, terrified of losing access to the heavy, physical, carbon-based energy that powers the traditional economy.
It's all about physical constraints.
But while this crisis of scarcity unfolds, we are seeing the exact opposite phenomenon occurring within the U.S. technology sector.
The AI revenue explosion.
Yes, we are transitioning from a world fighting over the remnants of legacy energy to a sector that is building machines that demand energy at a scale we have never seen before. And they're generating revenues that defy the laws of economic gravity.
The acceleration in the AI sector is frankly difficult to contextualize using traditional financial metrics. I mean, the revenue figures outlined in the source material are staggering.
Staggering feels like an understatement. The sources report that OpenAI has reached a $20 billion annualized run rate, or ARR, in a span of just 24 months. And Anthropic, their primary competitor, has hit a $13 billion ARR. But the data point that completely broke my mental model was Anthropic's performance in February alone.
The $6 billion month.
Yes, they reportedly generated $6 billion in top-line revenue in a single 28-day month.
To put that in perspective, look at the historical giants of enterprise software. Companies like Snowflake or Databricks are considered some of the most successful SaaS businesses in history.
Oh, absolutely.
It took them over a decade of relentless sales cycles, massive marketing budgets, and slow corporate adoption to reach those kinds of multi-billion-dollar annualized numbers.
And Anthropic achieved a decade's worth of SaaS revenue growth in 4 weeks.
Which instantly triggers some skepticism in the market. When you see numbers that large moving that fast, you really have to ask what is actually structurally supporting them.
Right. Are these companies just burning venture capital, or is this real?
Yeah.
Our sources capture a really intense debate among venture capitalists and institutional investors right now.
Yes. The skeptical camp refers to this massive influx of cash as experimental run rate revenue. Their argument is that these multi-billion-dollar figures aren't driven by actual utility, but by corporate panic.
Corporate FOMO, fear of missing out.
Precisely. You have the boards of directors at every major Fortune 500 company demanding to know what their executive team's AI strategy is.
And the easiest way for a middle manager to answer that question without actually changing how the business operates is to simply buy thousands of AI subscription licenses.
Exactly. They pay $200 a month per employee just to check a box on a quarterly report.
Look, we bought the software. We are an AI-driven company now.
Right. But crucially, the skeptics point out that these massive corporations are explicitly prohibiting their employees from integrating these AI tools into any critical, liable workflows.
Because the concept of liability with an autonomous agent is terrifying.
Oh, absolutely.
If a hospital network uses a language model to triage patients, and it hallucinates a misdiagnosis that leads to a fatality, the liability doesn't fall on the AI company, it falls on the hospital.
Or if a major bank uses an AI to execute trades and it misinterprets a regulatory filing, the SEC is coming after the bank's executives.
The stakes of being wrong are simply too high for entrenched, heavily regulated companies to actually use the technology they are paying billions of dollars for.
That is the core of the experimental revenue argument. However, the optimistic side of the debate insists that applying traditional software as a service metrics to AI is a fundamental category error.
We shouldn't be looking at this as a bloated IT budget. We should be looking at it as the privatization of a structurally constrained labor force.
Exactly. It's actual production value.
Here's where it gets really interesting. The argument is that buying an enterprise license for an AI coding assistant isn't like buying a seat for Microsoft Word. It's like buying metered electricity.
You are purchasing raw cognitive labor that you can turn on and off with a switch.
Right. If a tech company needs to spin up a new database architecture, they don't have to spend 6 months interviewing candidates, negotiating equity packages, and pampering human software engineers with kind bars and ping pong tables.
They just purchase compute tokens and generate the code. It is a mechanism to bypass the ultimate bottleneck of the digital economy, the severe shortage of elite human software engineers.
So if you can augment your existing engineering team to be 10 times more productive using metered AI labor, The $20 billion these companies are spending is actually a massive bargain.
It is, but I have to bring up a specific incident highlighted in the sources.
Oh, the Amazon issue.
Yes. It heavily undercuts the perfect digital worker narrative. Amazon had to actively issue an internal edict forcing engineers to put human oversight back into the loop because their autonomous AI coding agents were actually taking down critical AWS servers.
But wait, if Amazon is putting humans back in the loop because AI agents took down AWS servers, aren't we just inflating a massive bubble? Where is the actual ROI for a Fortune 500 company?
Well, the AWS incident is a perfect example of how the mechanics of AI failure differ entirely from human failure.
How does an AI actually break a massive cloud infrastructure like AWS? It's not acting maliciously, right?
Not at all. It's an issue of recursive loops. An AI agent is given a task to optimize a database query. It writes a piece of code, deploys it, and receives an error message.
Okay, pretty standard.
But instead of pausing to understand the architectural reason for the error like a human would, it instantly rewrites the code and tries again. It might do this thousands of times a second.
Oh, wow.
It creates a massive memory leak, pinging the server millions of times, effectively launching a highly localized denial-of-service attack on its own infrastructure until the entire node collapses under the compute load.
So if the AI is actively breaking the most robust internet infrastructure on the planet, and the Fortune 500 is only buying it as a PR stunt to appease their board, where is the actual ROI cementing itself in the economy?
According to the source data, the real production value is happening entirely outside the view of the Fortune 500. Exactly. The established corporations are paralyzed by middle management.
Which makes perfect psychological sense, right? If you are a vice president of operations at a massive logistics company and you successfully implement an AI system that automates 60% of your department's daily tasks, you haven't just saved the company money.
You've proven you're obsolete.
Exactly. You have essentially proven to your boss that your entire department and your lucrative management salary is no longer necessary. There's a massive inherent disincentive for middle management to successfully deploy this technology.
Which is why the true aggressive adoption is happening in the startup ecosystem. Startups have zero institutional bloat, no legacy management structures to protect, and extremely limited capital. They have everything to gain and nothing to lose.
The sources outline how startups are utilizing these large language models as immediate replacements for traditional overhead. Take SDRs, for example, sales development representatives.
Right. Historically, if a startup wanted to grow, they had to hire an army of entry-level SDRs.
Whose entire job was to scrape LinkedIn profiles, write customized cold emails, and try to book introductory meetings. It's expensive, high-turnover grunt work.
Now, startups are plugging AI agents directly into their CRM software. The AI can instantly analyze 10,000 prospect profiles, draft 10,000 highly personalized emails referencing specific corporate achievements, and manage the follow-up replies.
All in a matter of seconds, for pennies on the dollar.
They're using it to bypass massive legal retainers by having AI review complex vendor contracts and flag anomalies. They're using it to automate their HR onboarding and their fundamental accounting reconciliation.
They're taking the expensive operational friction of running a business and feeding it entirely to the machine. That is where the genuine sticky ROI is.
But scaling that digital labor requires a physical footprint that is almost incomprehensible.
Yeah, this is where the digital meets the physical. While the tech industry tries to build the infrastructure to support this growth, their own PR strategies are coming back to haunt them, physically halting their progress.
The math of AI infrastructure is staggering. The sources outline what they call the J-curve.
Okay, let's break down the J-curve for the listener.
Yeah.
Visually, if you look at a graph of profitability, it looks like a massive letter J.
Right.
It starts with a precipitous, terrifying drop deep into negative territory. That represents an enormous upfront capital expenditure.
And then eventually it turns around and rockets upward into sustained profitability.
So what does that look like in dollars?
The sources estimate it costs roughly $50 billion to build a single 1 gigawatt data center.
$50 billion for one building. And a gigawatt of continuous power draw is roughly equivalent to the energy required to power a mid-sized American city like San Francisco 24 hours a day.
Yes, and these companies aren't trying to build one of these. They're trying to build dozens of them. You are purchasing massive tracts of industrial land.
Yeah.
You are negotiating complex power purchase agreements with regional utility monopolies to guarantee a decade of uninterrupted electricity.
You're pouring hundreds of thousands of tons of specialized concrete to handle the physical weight of the server racks, and you're buying tens of thousands of advanced NVIDIA silicon chips.
And once you spend that $50 billion, you don't see a dime of return for half a decade. That is the bottom of the J-curve.
It takes roughly 5 to 6 years of continuous operation, depreciation, and software optimization just to break even on that initial capital outlay.
But the payoff at the end of that curve is what's driving this arms race. The models project that once a 1 gigawatt data center crosses that break-even threshold, it can generate upwards of $10 billion in pure profit every single year.
It's a license to print money.
But only if you can survive the 5-year gauntlet of bleeding capital. And surviving that gauntlet requires something money can't always buy: local municipal permission.
This is where the industry's ambitions are colliding violently with local realities. The sources cite a shocking statistic. Roughly 40% of all protested data center projects in the United States are currently being canceled or indefinitely delayed by local zoning boards and city councils.
It's a massive roadblock.
Using the J-curve math we just discussed, if 40% of these are blocked, we're talking about erasing tens of billions of dollars a year in projected future profits. Why are local governments suddenly so terrified of a building filled with computer servers? They don't emit toxic smoke, they just hum quietly.
Well, they're terrified because the tech industry spent the last 3 years intentionally terrifying them. We are witnessing the fallout of what the sources call the AI PR nightmare.
Right. If you're a CEO, why on earth would you intentionally tell the public your product might destroy their livelihoods? Is this just terrible communication, or is there a darker strategy here?
It's absolutely a darker strategy. We're talking about figures like Sam Altman of OpenAI and Dario Amodei of Anthropic. Their entire public communication strategy over the last few years relied heavily on a concept known as doomerism.
Doomerism, the intentional amplification of existential risk.
Exactly. These executives went on massive media tours, sat before congressional committees, and repeatedly stated that the technology they were building was so incredibly powerful that it had a non-zero chance of spontaneously waking up and extinguishing human civilization.
Or, at the very least, completely obliterating the global labor market, replacing every doctor, lawyer, accountant, and artist on the planet.
From a purely cynical fundraising perspective, the strategy was brilliant. They approached the largest sovereign wealth funds and venture capital firms in the world and pitched themselves as the modern equivalent of the Manhattan Project.
They said, "We are building a godlike, omnipotent intelligence. It is incredibly dangerous. Therefore, you need to give us $100 billion so that we are the ones who control it rather than a less responsible competitor."
And the VCs wrote the checks. It worked flawlessly. But the problem is, the local city council members in rural Virginia and Ohio were watching those exact same interviews.
Oh, wow. Yeah.
You have a tech conglomerate approaching a small municipality, asking to build a massive power-draining facility in their community. And the local residents are saying, wait a minute, you're the same CEO who testified last month that this machine might destroy the working class. Why on earth would we grant you the zoning permits to build it in our backyard?
The doomer narrative successfully extracted billions from investors, but it thoroughly poisoned the well with the local municipalities required to physically house the technology. But you mentioned a darker strategy: regulatory capture.
Yes, regulatory capture. By scaring the public, tech giants encourage governments to create heavy licensing schemes that only the richest companies can afford to comply with.
It's pulling the ladder up behind you. If you convince lawmakers that training an AI model is inherently dangerous, the government demands a massive bureaucratic compliance apparatus, multi-million-dollar auditing licenses, mandatory safety review boards, years of red tape.
And who are the only entities capable of absorbing those massive compliance costs? The incumbent giants who already raised their $50 billion.
Effectively locking out open-source competitors. A lean startup is instantly legislated out of existence.
The sources highlight how this fear is weaponized by groups like the Future of Life Institute, who push lawmakers to treat AI with regulatory severity.
And we're already seeing the tragic real-world casualties of this manufactured fear. New York is trying to ban medical and legal AI chatbots.
Which is deeply ironic.
Yeah, because it explicitly hurts the poorest citizens. The stated goal is to protect citizens from unqualified digital advice. But who actually uses a free legal AI chatbot? It's a single mother facing an illegal eviction notice who can't afford a $400 an hour retainer for a human attorney.
Or an uninsured gig worker trying to understand a terrifying medical symptom who can't afford a $200 primary care copay.
By banning these AI tools, lawmakers are protecting the lucrative monopolies of the legal and medical professions, legally mandating that if a vulnerable citizen cannot afford a human professional, they're simply not allowed to use a free digital alternative.
It's a profound failure of public policy. And this local resistance to data centers and tech development ties perfectly into a broader theme: states attacking wealth creators.
Exactly. Just as local governments are blocking the physical infrastructure of the future, state governments are actively trying to seize the capital required to build it.
We are witnessing a taxation tug-of-war. As the technological sector generates this unprecedented wave of wealth, state governments are deploying radically aggressive tax frameworks to capture it.
And completely underestimating the mobility of modern capital. I mean, look at Washington State. They recently passed a 9.9% millionaire tax, which basically immediately resulted in Starbucks founder Howard Schultz moving to Miami.
And the sources also mention federal proposals for a 5% annual wealth tax. But the most aggressive mechanism detailed is California's attempt at a billionaire asset seizure tax.
A tax on unrealized gains, meaning you aren't taxing the profit someone made when they sold a stock. You are demanding a percentage of the theoretical value of the stock they still hold.
What's fascinating here is the mathematical reality of these taxes. The sources cite a Monte Carlo simulation conducted by the Hoover Institution regarding the California tax.
So they ran the odds, basically.
They ran 100,000 simulations, accounting for human behavior, how mobile billionaires are. And in 71% of scenarios, the tax results in a negative net present value.
Wait, really? A negative value?
Yes. It creates a $25 billion hole in the state budget due to capital flight. When you threaten to seize unrealized net worth, billionaires don't sit there and write the check. They hire lawyers, buy a house in Texas or Florida, and change their legal residency before the tax goes into effect.
It's like a restaurant owner realizing he isn't making enough profit, so he decides to quadruple the price of every item on the menu overnight. He opens the doors the next morning expecting to be rich, only to find the dining room completely empty. The wealthy are highly mobile.
And when they leave, they take all the traditional taxes they were already paying with them, which blasts that $25 billion hole in the budget. And the middle class will ultimately have to pay for it to keep the state running.
But from the state's perspective, and keeping our neutrality here, they have massive obligations, right? Schools, infrastructure, healthcare. If they don't tax the massive wealth generated by tech and AI, how do they fix the broken system?
Well, the sources present a strong counterargument. The solution isn't asset seizure, it's utilizing technology to lower the cost of living.
Use the tech to fix the system.
Right. The sources argue AI can break the cartels in education and healthcare, radically lowering costs. If an AI can diagnose medical imagery or handle insurance billing, the fundamental cost of healthcare plummets.
And in education, you deploy personalized AI tutors rather than taxing a tech founder to build a slightly newer traditional school building.
Exactly. Furthermore, the sources highlight alternative wealth-building ideas like the Invest America program, also called Trump accounts.
Oh, this is fascinating. The goal is to give 30 million kids $250 in equities, like the S&P 500, to get Main Street participating in capitalism.
Broadening ownership rather than just taxing the wealthy. By giving 30 million children a direct equity stake in the American corporate machine, you functionally align the interests of Main Street with the ambitions of Silicon Valley.
So if the tech billionaires succeed in building a gigawatt data center that generates $10 billion in profit, the value of the S&P 500 goes up and the child's investment account grows. It's a structural attempt to ensure everyone rides the wave.
It's a completely different paradigm.
It really is. We've covered a massive amount of ground today. Let's pull the camera back and tie this entire journey together for the listener.
Good idea.
We live in a world where the physical constraints of the old economy, like the oil choke points in the Middle East, causing that giant parking lot at the Strait of Hormuz, are violently clashing with the limitless ambitions of the new economy.
AI scaling, massive, multi-billion-dollar gigawatt data centers, unprecedented wealth creation.
Right. Yet, as we've seen, the biggest threats to this new era might not be foreign adversaries at all. The threats are internal narratives.
Doomer PR creating regulatory capture, local NIMBism blocking data centers, and state tax policies on unrealized gains driving capital away.
Which leaves us with a final lingering question for you to mull over as we wrap up.
If AI continues to require more energy and our traditional energy sources remain hostage to fragile geopolitical choke points, will the ultimate winner of the AI race be the country with the best algorithms, or simply the country that figures out how to keep the lights on without taxing its innovators out of existence?
That is the multi-trillion-dollar question. Thank you so much for joining us on this deep dive into the raw mechanics of the current global shift. We hope this helped connect the dots for you. Stay curious, and we will catch you next time.